Hello again, ladies and gentlemen. Patrick L. Young back with another IPO video. Snippets to help make you a better investment in the stock market and beyond. You'll have noticed something very materially different this week. I'm joined by Toffee the bunny. Toffee is an expert in soft commodities trading, particularly, it has to be said, carrots and other things you can eat, particularly green leaves and shoots. At the same time, it's a joy to have him here this week, while we have got Toby working on other special projects for the future. However, what I wanted to talk about today was back to this whole topic of growth. As I've mentioned before, growth is a good thing. Growth is good because it enlarges the pie. And this is one of the biggest fallacies of economics. People look at economics as being a fixed pie, and therefore they all want their particular allocation within it. The truth is that with economic growth, we can manage to make the pie bigger. By making the pie bigger, everybody, even if their slice is only the same percentage of what it was before of the whole pie, can actually amount to more. And thus economies grow. Thus people end up from an agrarian base working in industry. Thus they end up in better industry. We innovate further, we turn digital. We do all sorts of wonderful and incredible and really natty little bits of engineering and design and product, and suddenly we've got this situation where people just don't even manage to understand how possibly people could have lived only a few hundred years ago without electric light, without cars, without planes, without all of the other wonderful things that you can have in modern day life, including of course the dear old interweb thingy, which is allowing us to commune today. So growth is good on an overall level. What about growth in stocks? Well, you see, there things are very interesting because there's a particular area of shares called growth stocks. And as you might expect, they're the ones that really explode. And well, they have the prodigious quantity to effectively multiply their profits, a bit like, well, bunnies like Toby and even Toffee. Bunnies can multiply their brood, such as Toffee and Toffee's very many members of Toffee's family, at a prodigious scale, which of course is known as sort of bunny multiplication. And therefore we get into, of course, the Fibonacci number series, to which we will return in a subsequent video, because obviously we've got the ideal co-star to discuss this. So growth, rather like the multiplication of rabbits, is something which ends up delivering a huge amount more in the world. More economic resources, more bunnies, etc., etc. More economic activity is good, and back to growth stocks. Growth stocks are so called because the emphasis of why we're investing in them is because they are growing rapidly. To take an example, that's to contrast them with, say, utility stocks. Utility stocks are things like electricity companies or water companies and so on. We don't buy electricity companies expecting that people are going to use a whole load more electricity over the course of the next few years. Of course not, if for no other reason than the fact that, Greta and all of her many acolytes would be running around the place and getting terribly upset at the extra usage of electricity. Rather, therefore, utility stocks are based on the idea that they have a kind of steady amount of business year in, year out. They try to make that business more efficient, they try to make more profit as a result, and therefore, ultimately, they are a wondrous stock because they often pay very nice amounts of dividends. Dividends being the little payment we can accept once or twice a year from a particular kind of share. So, therefore, utility stocks are wonderful because they're steady, and effectively they should rise gradually over time as they become more economically efficient and they deliver a little bit more electricity or a little bit more water, precisely because the economy has grown, the population has grown, and so on. That's one particularly interesting group of share. But back to our friends, the growth stock. Now, the growth stock, that's a totally different animal. Unlike the utility, which already has umpteen thousand different customers around the country, the globe, the city, wherever its frame of reference is, the growth stock is quite often a new thing. It's something very frequently that comes in new technology. That's why for many years we've been excited by the wonderful things, the value that can be delivered by the interweb. And let's face it, look at the whole economy of the internet itself, which has exploded. And while it has done some harm to certain elements of the old line economy, nobody can argue life is more efficient, the economy is bigger, and we are all thus overall better off as a result. The thing about growth stocks, of course, is that growth stocks may not actually obsess about the concept of, well, profit. And this is, of course, a very interesting and, well, sometimes worrying issue, because where a growth stock goes for is they go for world domination. They want to effectively try and get as many customers as fast as possible. And thus we see in many internet plays in particular that we've seen in recent years, things like the Airbnbs of this world and many, many others. We also saw it most recently in an example, for example, WeWork, the building sharing, office sharing organization. So these companies, what they tend to do is they prioritize quite often their growth instead of profitability. Why do they do that? Because obviously, if they can manage to get umpteen zillion billion customers around the world, then it doesn't take them to make a huge amount of money out of each of those umpteen zillion billion customers in order for the business to be incredibly profitable as a whole. Equally, investors love the idea of getting something which has a fabulously exciting upwards trajectory of customer numbers and grows rapidly. Thus, of course, investors will often pay giddy multiples for these sorts of companies. So, growth stocks, exciting things to own in exciting economies, but of course, the problem with them is they're always leaving the actual issue of profit until tomorrow, the day after tomorrow, or even many, many years from now. Nevertheless, growth stocks are interesting, but they're not, of course, a stock for all seasons. And I'll get on to that in my next video. From myself, Patrick L. Young, and the wonderfully relaxed Toffee the Rabbit, good day to you from Valletta. Have a lovely day in life and markets.